Hi, Matthew. My name's Ian Cockerill. I'm the Chief Executive Officer of Endeavour Mining. Endeavour Mining is a West African-focused gold producer. We have 5 operating mines in West Africa across 3 jurisdictions. We're producing somewhere in the order of about 1.2 million ounces of gold a year. We're very proud that we're one of the lowest cost producers in the industry. And importantly, we've got a very interesting growth profile until the end of the decade.
Super, Ian, lovely to meet you. First time we've met or spoken, so I'm quite excited about this one. Before we start, I think a lot of people will know who you are, but maybe some won't. Maybe give us a little bit of the background and the relevant experience that you kind of brought into this role.
Okay, very briefly, born, raised, educated in the UK, graduated with a degree in geology, went out to Africa, worked my way through the mines, eventually landed up as the Chief Executive Officer of Goldfields. That was from 2002 through to 2008, and then stepped away from Goldfields, had a short spell back with Anglo American, and then in 2010 started a portfolio career, managing and being on the board of several companies, chairing the likes of the BlackRock World Mining Trust, as well as the old Polymetal. My last tenure was as the Deputy Chair of Endeavour. At the same time, I was the non-exec director of BHP, and then became the Chief Executive Officer of Endeavour January 2024.
Right, fantastic. Okay, look, we're going to talk about the kind of Q1 numbers, and particularly the kind of 99% increase in adjusted net earnings and the cash flow and so forth. But I'm interested in how we got here. You landed with a thud, an explosion in January 2024. What were the things that you felt you needed to change and implement, which maybe contributed towards this quarter's numbers?
Look, I mean, clearly the first thing to do was to stabilize the ship. There was a lot of volatility. We needed to get some stability. We needed a clear direction that everyone could follow. And I set up a very simple strategy, which I call the 4 E's. And the 4 E's was 1, the right employees in the right place at the right time. So that meant sort of shuffling some people got shuffled around and put into new positions. It was excellence in operations, and that was making sure that we had excellent cost control, great productivity, and also making sure that we were able to deliver against our targets. Then we said that the one core part of the DNA of Endeavour was that we've always been a very strong and very prolific explorer. Our discovery costs over the last 7 or 8 years, we've discovered just short of 20 million ounces. And we've been able to do that for less than $25 an ounce. That's fantastic value accretion, and we wanted to continue doing that. And last but by no means least, it was making sure that we were in a position to expand our portfolio so we could build off our very strong base of low-cost operations, but taking us into the future with some growth. And we're now in that position where we're somewhat unique in this space, Matthew. I mean, normally in the gold space, people are either a yield play or they're a growth play. We at Endeavour, we're actually both. We're sector-leading yield, about 6% yield on our stock. Plus, between now and the end of the decade, we're going to be a 30 to 35% higher level of production, which is going to be very much driven by our new project, Asafu. So very exciting space and time to be with Endeavour.
4 E's, I love it. Okay, simple. So how do you, I'm getting away from the questions I prepared because I quite like this. How do you implement something like as simple as that, the 4 E's with your team? Do you dictate or do you enable?
Leadership is all about crafting a vision, selling that vision to a group of people that you trust, and then letting them get on with it and get out of the way and let them get on with it. It's tasking them to do something. It's trusting them that they can do it because they've got the right skills, the right attributes, and it's tending them in as much as monitoring and evaluating how they're progressing, motivating them to get a little bit more focused or don't lose sight of what we're doing. That's all it's about, and that's leadership.
Right, and how do the institutional shareholders view that? Because you talk about sort of sitting in both camps, in the sense of, are you yield, are you growth? How do they understand that?
They're beginning to understand it. I mean, last year there was clearly a lot of confusion. Well, we're not performing as well as we would like to have done. They're now recognizing that basically since Q3 of last year, strong production turnaround, a lot of the initiatives that we've put in place are beginning to pay dividends, literally within the company. And they're recognizing that this is a company that is incredibly well positioned now to deliver. We've had 5 quarters of growing production. We've had growing free cash flow. Importantly, we've maintained a very strict discipline on our costs. So where you get strong production, low and sort of static cost of production, hitting a rising gold price, you get an expanding margin. And importantly, that is for the benefit of our investors, not just to make our job easier.
Right, and with the employees, I mean, obviously, you need to make your own imprint in the organization. Was there any resistance to that, or was it easily understood, or was it a sort of subtle change?
No, look, I mean, I guess I had a real key advantage because I was a known quantity. I'd been on the board a couple of times, so it wasn't as if I was a complete unknown to the team. I think the team were looking, for some sort of focus in terms of direction, and I think that what I had tried to provide was a very simple and clear message about, guys, this is what we've got to do. So it wasn't difficult to comprehend. It wasn't seen as rocket science. I think there was an intrinsic trust in what I was trying to do. And that helped. And, they're good people. They're very sound people. So it was not a difficult sell.
Okay, so you've kind of gone through this kind of transition from a project-heavy phase to a kind of cash-yielding business with growing expectations around dividends and buybacks. So you're moving that kind of sentiment in the market and internally. What I'm trying to understand what that looks like internally. So if we go to the second E, which is excellence, I think from what you said, can you provide maybe a little bit more detail at asset level on how each mine performed versus internal expectations in Q1 2025?
I think the nice thing about mining is a really straightforward business. It's the people who tend to sort of mess it up. But the basic fundamental mining equation is profit equals revenue minus cost. Now, we can do nothing about the price, but what we can do is we can actually make sure that we produce as many ounces as possible. So high price, high volume gives you good revenue. But what we can do is we can really make a difference on the cost side. And cost is not just about what we spend, it's how we spend it. Are we spending money wisely? Are we getting good productivity? Are we getting the maximum amount of recovery of our gold? We spend a certain amount of money to run our gold plants. Whether you get 100% recovery or 80% recovery, it's still the same, but the cost of an ounce produced could be quite different. So all these little bits and pieces, are we productive? How do we actually make our mining operations more run like a Swiss railway as opposed to some clunky British rail type thing, on a suburban line? It's not one thing, Matthew. It's a collection of initiatives down at grassroots level, and importantly, saying to the guys at the mine, tell me what you can do at your operation to make your operation work a lot more efficiently, a lot more effectively. What do you need to make that work? I'm here not to tell you you've got to do it. I'm here to help you achieve that. And slowly the guys realizing that they can make a difference. And we're seeing on every single mine almost an encyclopedia of initiatives that says, well, we can do this better, we can do that better. Sometimes it needs a little bit of money to get there, but that's fine. As long as they can justify the cost of that investment and it's going to enhance return, they're given the money. And we're seeing a lot of those benefits come through. Some have not worked. Many of them are working really, really well. And that's where we're seeing this accumulation in aggregate of all these initiatives is playing out in terms of enhanced production and in terms of cost control. So we're controlling our inputs, and it's leading to better outputs. That's the important thing.
Okay, but do you lead that with, look, by 2030 we're targeting 1.5 million ounces annual production with stable costs, etc. And you're saying to people, send in your ideas with budgets, and they shall be considered. So you're getting ideas from around the organization. I guess upward reporting. How do you measure, value that, grade that going forward? Because I imagine that's a lot of new ideas coming into play.
Well, it is, but every single mine has got its laundry list of initiatives. It's got against that perhaps what it's going to cost, what is the current level of performance, what is the projected performance, and then we monitor progress. Now, sometimes you don't get there immediately, you're actually tracking towards it. But every single initiative, we are tracking its performance. If it's working, we push it harder. If it's not working, you stop it.
Right. You've obviously got a big portfolio of companies, and you've learned lessons across the group, across the portfolio. And it's great, I guess, focusing on the production, because I imagine that's what the institutions want to see. They want to see, what do the resources look like? What do the reserves look like? And what do those margins look like? In terms of things you can't control, obviously, price of the metal, the geology, etc. Do you come at those things differently in terms of kind of how you hedge and control those budgets, budget allocation, say?
Generally speaking, as a company, we're not a hedging company. There are some historic hedges that were put in place, but these were not so much hedges, but they were price protection during the capital build phase that we had. And we put those in place so that, because we wanted to maintain a reasonable degree of shareholder return through the build cycle, but we wanted to make sure that we had sufficient cash that we were able to pay the bills for the construction. To do that, we felt it was prudent to put in bottom price protection. We had that. Now there is a couple of those hedges that still, the tail of them are still in place. We have them at the moment, but once they're out, and they'll be out this year, then we're done. We don't want to have hedging in place because, frankly, what we're saying is we're going to make sure that our mines can operate at a sufficiently low cost level that, bluntly, hedges are irrelevant. They're not needed. We want to create a resilient organization irrespective of the gold price.
Okay, fair enough. Is there a kind of, there's always got to be, because mines are putting out small fires every day, figuratively. So is there kind of risk management framework in which your team operates or understands?
Well, obviously we look at what are all the risks involved. There are things that we can do to make sure that we are spending wisely. We've had many initiatives over the years where we've probably concentrated a lot more over the last few years in terms of what I would call group purchase, because we find that bulk buying obviously helps bring our costs down. That has certainly saved us a lot of money, as opposed to buying just at the local level. And you get the bulk buying impact. So I think that's one area that we've reduced the risk in terms of costs running away from us. And you can see it in our numbers. Our numbers are very flat over the last 5-6 quarters. And I think it shows that what we're doing is working well.
Okay. And referring to the institutional shareholders earlier, starting to understand your way of thinking and your way of, I guess, reporting, but they have their own ways that they like to comp you as a African producer against the rest of their portfolio of investments. So do you have to adjust to that, or do you feel that perhaps there's this new vision of yours maybe has legs, and maybe they could start to view you and comp you differently? Because I think African players tend to get a kind of Africa discount, don't they?
They can do, but as I said to many people, irrespective of where you operate, it doesn't even matter what business you're in. There are challenges everywhere around the world. Let's be honest, 6 months ago, we would never have thought that there would be challenges in the OECD countries. And in fact, the volatility in OECD countries is arguably higher than it is. Africa is looking at relatively lake of calm at the moment. But we have operated, in West Africa, for a long time now, and we've shown that we can cope with those challenges. We have given outsized returns to investors over the years, and that's because we know how to manage in these environments. We operate well, on a day-to-day basis. We've got people interacting with regulators and what have you, and we as a company are comfortable where we are. I think investors know you invest in Endeavour Mining. Currently it is a West African gold play. You pays your money and you takes the chances.
Right. Okay. Well, I guess to that end, you're generating a lot of cash. I mean, it might be worth sort of reminding us some of the numbers around this Q. I know it's a week on, but maybe again for those who missed it, remind us of the top line Q1 numbers.
Well, the only number that's important is how much money is left over after you've paid all the bills. And in terms of free cash flow, $411 million for the quarter, which is, again, really, really good number. Very pleasing that over the last 5 quarters, every quarter, it just got bigger and bigger and bigger. And we're very pleased. And I think it's vindication of the strategy that we've got in place that is really delivering. And it isn't just the higher gold price. All these other initiatives I've mentioned have certainly helped bolster that. So, and I think to put it in perspective, over the last 3 quarters, which is basically the end of our growth investment phase and now moving into what I call shareholder return phase, during that period, we've actually delivered free cash flow of $775 million, which is equivalent to $795 for every single ounce that we've produced. That's a really excellent return. Now, going forward, God willing, the gold price is going to maintain, and I do believe it will do. Shareholders can expect very strong returns this year. Last year, we returned $277 million to shareholders for the whole year, which, even for us, that was a very good year in terms of shareholder return. This year, we've promised shareholders a guaranteed dividend of $225 million. On top of that, we said, subject to performance, subject to gold price, there will be additional cash supplement to dividends, plus share buybacks. Already in Q1, on top of the 225 guaranteed, we've already done $55 million of buybacks. So we've already delivered the same guaranteed shareholder returns to shareholders in Q1, and we still have 3 quarters left. So I think, at current gold prices, you don't need to be a rocket scientist to know that shareholders are going to do very well this year.
Okay, so dividends and share buybacks going well, and cash generation, free cash flow going exceptionally well. Valuations compared to peers. I mean, I want to come back to that. Yeah, you're right in pointing out that a lot of jurisdictions have their own issues to deal with. But do you think you are fairly valued?
Well, look, I think most investors will tell you that we remain undervalued. What's really pleasing, I mean, last year we basically underperformed most of the market, and I think that was really due to the volatility that we had in the organization. But it was quite obvious from about October onwards, people started to regain trust in the company. And if you look over the last couple of months, that valuation gap that had opened up from the beginning of 24 has been closing quite rapidly. And what we're seeing over the more recent past is an acceleration of the closure of that gap. And I think that, again, is due to people having a lot more comfort that, yes, the free cash flow inflection is definitely there. They're seeing more consistent performance from the group, and they're seeing in the hard numbers. It's a question of show me the money, and they're seeing the money. And because of that, we're seeing our valuation close, and yet we're still on a relative basis lower than many people, which really just offers a great opportunity for people to really look at the the share and say, despite good performance, it's still not too late to get on board.
Right. Okay. So for those that kind of look at West Africa and go, well, it's big. It has been uncertain times in some countries, in some parts of some countries as well. Your ability to continue to mine, produce, sell, generate free cash flow, as you say, is a kind of testament to where your projects are. But what are the sort of government or community partnerships that have enabled you to be able to operate without hindrance?
I think it's more a question of, over time, you build up these interpersonal relationships. I mean, obviously there's regime changes from time to time in West Africa, but on the ground you find a lot of the administrators, and it's the same in the UK. Governments come and go. The civil service tends to be fairly consistent, and it's the same, I think, for us as well. We have, across all of our jurisdictions, we have country managers. Their sole responsibility is day-to-day interaction with regulators, with the administrators, making sure that if ever there are issues, we debate and we sort of interact, we raise concerns. And the one thing that's important in Africa, it's always best to raise those concerns privately. You're not seen to sort of publicly chastise, because that never goes down well. But you can do it privately, one-on-one. And we've always found that the regulators are open to us having that interaction. I for instance, I've had 3 interactions in this past 9 months, at the highest levels across Burkina Faso. I was with the president 3 weeks ago, and it was a really good interaction. And I think it's that mutual sort of trust and that personal interaction that you build. It's those sort of things. And I have to say, it's what I really enjoy about working across Africa. And I've worked across quite a lot of Africa. You do still have that ability to create one-on-one sort of relationships, which is much more difficult in sort of the Western world. Much more difficult.
Yeah, no, agree with that. Absolutely agree with that. Used to do the same thing myself. Quite enjoyed it. Let's just kind of look to the future now, because obviously it's a great set of Q1 numbers. Very, very, very encouraging indeed. But it's, as you say, growth is part of the story there. The exploration, the expansion component. Can you sort of talk us through maybe what that actually means in deliverable terms over, let's say, maybe the next sort of 3 years or so?
Yeah, as I said earlier, at the moment, this year, we're guiding between 1.1 and 1.25 million ounces. If you take where we were at the beginning of the year to the end of this decade, we're sort of guiding towards 1.5 million ounces of production. That's organic growth. That's aside from any other activity that may take place. Where's that coming from? Principally, it's coming from full years of operation of our 2 projects that were completed last year, which is the Sabodala BIOX plant, as well as the brand new Lafigué mine. But more importantly is the new Assafou mine, which is in the eastern side of Côte d'Ivoire, towards the border with Ghana. We released the PFS study at the end of last year. This is an incredibly attractive project. We're talking about a project, it's going to be 350,000 ounces a year. It is got a 15-year life. Even at $2,000 an ounce, this has got an incredibly robust IRR. And it's going to be producing gold, at or below $1,000 per ounce all-in sustaining cost. Incredibly robust. Arguably the best discovery in West Africa over the last decade. It's a proper tier 1 asset. And certainly, at $3,000+ per ounce, very, very strong creator of value. And we found that asset, and it's got just under 5 million ounces of resource, of which 4.3 million ounces reports to reserve. So that's just on the reserve that we're studying for the definitive feasibility study, which will be concluded at the end of this year. But we're seeing around this mine, we're seeing lots of other satellite deposits, which will add to the inventory that will be mined. So lots of scope down the road, possibly for either life extension or possibly even throughout the normal life, an increase in production. That's where the growth is coming from. And I have to say, I'm really, really excited. And then 60 kilometers to the east of that, we've invested in another potential discovery that could even add more. So lots to be excited about there. And then on our individual mines, we've identified potential opportunities that could be really sort of exciting for the group as a whole. So no shortage of organic growth opportunities, that's for sure.
Ian, thank you very much for the catch up and obviously introduction to yourself as well. I've really enjoyed listening to that. Stay in touch and we'll speak to you soon.
Thank you very much. Thank you.